This is the video for Wednesday, March 24th. If it's so costly to not pay the entire balance on a credit card, why does anyone use a credit card? What are some reasons you can think of? So maybe write down a reason or two why you think that somebody might use a credit card instead of a debit card. Pause the video and then we'll resume. So a couple reasons. One is to build credit. Now, we've talked a little bit about building credit. We'll talk more today about what building credit means. And reason number two would be credit card points for airlines and things like that. And again, this is using a credit card instead of a debit card. So you wouldn't say something like not having to deal with cash and change and things like that, because you don't have to deal with cash and change when you use a debit card either. All right, so what is credit? Credit is the ability of a customer to obtain goods or services before payment based on the trust that payment will be made in the future. So when you have a credit card, for example, really that's what that is you are obtaining the goods now and you are paying for it later. And so you're borrowing the money from the credit card company who you're going to pay back at a future time. What are some things that you might pay for with credit and why? And I'm not talking about things that you can buy with a credit card. I'm talking about things that are so big that you have to borrow money to pay for it, because you can't just afford, you probably just can't afford to pay for it. So some things that I came up with: a house, for example. That is the most acceptable one, because you might be waiting decades to be able to buy a house if you weren't able to borrow money to pay for it. So most people pay for a house on 30 years credit, call that a mortgage. Maybe a car. Now, a car is a little less acceptable. You maybe want to consider paying cash for a car and buying the whole thing up front, but a car is sometimes big enough and it makes sense to buy it on credit. School, education, student loans, for example. You always want to be careful when you're taking student loans, but a lot of people do. Anything else? I mean, there's a ton of things: furniture, cell phones, lots of things you can pay for using credit. So you think you'll get that loan, right? Do you think you will automatically get the loan? Yes or no? You can put it in that box right there. Well, banks actually choose who gets the loan and who does not. That doesn't seem fair. Why do they get to do that? Well, imagine that you are lending money to a family member or friend. What factors would you consider when deciding whether to lend money to someone? Give me a list of factors that you would consider about whether they would pay it back. Here are some I came up with: trust, reliability, history of returning borrowed items in good shape, or on time. So those factors, this concept is known as creditworthiness. Whether you would lend somebody money. So creditworthiness is, in this box called creditworthiness in your notes, is an analysis made by a lender when deciding whether or not to lend money to a customer. The bank uses the same criteria that you use when deciding whether to lend money to someone. Okay, so let's say you've got a friend and you lend them $1 today, and they need to buy something from the vending machine, and you give them $1, and then the next day they come back and they say, "Hey, can I borrow $1 to buy something from the vending machine?" Now, you're going to say, "Wait a minute, I'll give you $1 yesterday. You were supposed to pay me back today, not ask for another $1. What's going on? Why are you doing this?" And then they'll give you whatever reason, and then it's up to you to decide. Maybe you'll do it again for a second $1, even again for a third $1. Maybe the $1 is less important to you than the friendship. Is not that big of a deal. But at a certain point, you start to believe that your friend is not going to pay you back. Well, the bank they don't have that option. Okay, they don't have the option to figure out they don't have maybe the history with that customer, or they don't know how likely this person is to pay, and so they're going to look at some other creditworthiness factors. Creditworthiness factors in your notes here. You only have to write the black part if you want. You don't need to write the red part. But creditworthiness factors include payment history, whether you've paid your bills on time, either bills like your cell phone bill or your Netflix or Hulu bill, or your power bill or your TV bill, or it could be credit card bills, car payment bills, things like that. The amount owed to current creditors. So whether you have a car payment or a balance on a store credit card. So imagine that you are imagine you're going to lend money to a friend and you know that they just borrowed money from another friend and they haven't paid that person back yet. Well, now you're not sure if you're at the front of the line to get repaid or the back of the line. And so if there is no line, you feel better about it. So the banks are going to figure out that same thing. If you've got a car payment, you can still get a house payment, a house loan. That would be one thing. But if you haven't paid your credit cards, if you have a lot of credit card debt, it might be difficult for you to get a house payment, like that sort of thing. The length of credit history in general, longer you've had access to credit and paid bills on time, the better. It's just more credit, more evidence that you're a responsible person who's going to pay things back. The types of credit used, for example, a car or mortgage payments are often viewed as better debt than consumer credit card debt, because usually consumer credit card debt is debt that arises from you not being able to say no to yourself. I want this thing, so I'm going to buy it, therefore I buy it, versus a house or even a car payment are more necessity things. And buying a house buying a house before you can afford to pay 100% cash for it, that's actually a sign of financial strength, right? That shows that you are financially responsible in a certain way. And then the number of accounts open. Lenders can be wary of borrowers with too much credit available. Same sort of thing with the amount owed. If you have a lot of accounts, then they might be negative. They might not want to lend to you. They might be against that. So we're going to take all these creditworthiness factors and we're going to compile them on a person's credit score. And that lets lenders know how risky it is to lend to that borrower. So if you are borrowing from a bank, they don't necessarily have the whole history with you. You didn't borrow $1 from them yesterday and not pay it back, or borrow $1 and then pay it back and then ask to borrow another $1. They don't have that. All they know is that you are, well, they don't know anything about you. So they have to look at this credit score. And so every time you make a payment for something, that company is going to give a positive report to the credit bureaus who are tracking these things. And then your bank can pull up your credit score and decide how good your credit is, how likely you are to pay that back. As far as the numbers go, the credit scores are between 300 and 850, and a credit score of 700 or above is generally considered good. The average is 710, and so a credit score of 800 is excellent. I don't know what my exact credit score is off the top of my head. I know that I've had perfect credit. I've never missed a payment for anything in my life. But to have excellent credit, you have to have decades of doing that. And I'm coming on 2 decades here, but I don't quite have 2 decades worth, and I certainly don't have 3 decades worth. So my credit score is good. It can get me the loan that I need, but it's not going to be amazing. So last question for today is, what can you do to protect or improve your credit now, even as a high school student? So what can you do? Well, there's going to be 2 parts to this, and one part is protecting your credit, so making sure that there's nothing going into the credit score that's bad, and that would be just making sure that you don't miss cell phone payments if that's under your name or things like that. And then what can you do to improve your credit? We talked yesterday about credit cards and how I think that they're risky just to get your credit, just to improve your credit, but maybe you could do something like what my mom did for me when I was in high school, where she put my name on her credit card, and every time she paid it off, it improved my credit. She added my name to her credit. Now, you only want to do that if your parents are financially responsible, and I don't know your individual parents. Maybe they are, maybe they aren't. But if they're paying that off every month, then maybe that would be a good way to build you some credit. You could also go into your bank and ask your bank if they have an option where you can get a bank credit card that only takes money out of your bank account you uh, until you get to where it's all spent, where you don't spend more than you have in the account. Ask them if they've got something like that. That could build your credit without having to worry about overspending. Or even you could try something, and this is a little more risky, where you get a credit card for something that is only like gas, like you only get it for gas because you're not going out and irresponsibly spending on gas. The danger with getting a credit card that would just be a regular Visa card that you use for everything is you overextend yourself and you spend more than you have. Well, if with gas, you're not spending more or less because you have a credit card, you're just spending the same amount. And so maybe you could try something like that, but it is still risky because now you need to be in charge of making those payments. So maybe what you could do is you could set it to automatically withdraw from your debit card, anything like that. I saw a commercial over the weekend that now if you have things like Netflix or Hulu or Spotify in your own name and with your social security number attached somehow, it'll report it to the credit companies. I don't quite know how that works because I don't think that they have my social security number for those things. So I don't know how they're reporting it without my social security number, but it is possible. So if you want, you can maybe look into that as well. So there are a few things you can do to improve your credit so that once you get out of high school, you don't have a credit score that's just not exist. You don't have a bad credit score, but you just have no credit score once you get out of college and you're starting to look for apartments and things. That is something that you have to sometimes worry about is even if you're not planning on borrowing money, sometimes if you're looking for an apartment, they will run a credit check to make sure that you can pay, make sure that you're trustworthy. And if you have no credit score, that might be difficult. So maybe it is time to start thinking about ways that you can, with very low risk, start to build your credit over the next few years while you're in college.